I heard a statistic recently in a study of millionaires that said that millionaires on average have seven sources of income. Seven, right? And there I was with my one. And so I started to take massive action to change that to expand and add other sources of income.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Fred Moskowitz. He's an educator and best-selling author who has trained countless investors from all walks of life on how to create passive income streams of their own. As a fund manager, Fred manages a mortgage note investment fund, is considered an industry veteran within the note investing arena. Fred was on the podcast once before, but it's been a while. I think probably like 2 years or something like that.
Yeah.
Thanks so much for coming back, and I'm really excited to talk. I think a lot has happened in the financial markets over the last couple of years, so I think we'll have some really interesting topics to touch on. But first, thank you for being here today. Thanks for taking the time out to chat with me.
Yes, thank you. It's great to be here. Great to be back.
Can you just give the listeners, maybe people didn't listen to the first one, but can you give us your background, kind of talk a bit about yourself and the space that you're in, and then we'll dive in from there?
Yeah, absolutely. A little bit about myself. I came from a long, successful career working as a computer engineer in the tech industry, right? And I loved working in tech. So exciting. I came up during the dot-com boom years, right? Real exciting times. And what happened was we went through the dot-com boom, and then the dot-com bubble burst. And so I saw that the industry I was working in was very cyclical. Not unlike many other industries, but the tech industry for sure is very cyclical. And this made me realize that I was taking on this huge risk because I was relying on my paycheck for my job as my only source of income. And I found that to be very risky. And so I always, when I speak to people, I speak to investors, I always ask, how risky is your paycheck? Think about that, right? Because I'll tell you what, I learned the hard way that it didn't matter how good of an engineer I was or how valuable of an employee I was. If there was a downturn or if the company was going under, I could quickly lose my job through no fault of my own. And so this led me to getting involved in alternative investments, investing in real estate. After a number of years, I got into investing in mortgage notes, but it's all about the idea of buying and building assets. And these are assets that you own, you control, and while you own them, here's the best part. It creates income for you, passive income. And so that's been really powerful for me about diversifying my income. I heard a statistic recently in a study of millionaires that said that millionaires on average have seven sources of income. Seven, right? And there I was with my one. And so I started to take massive action to change that to expand and add other sources of income. And so this is the main message that I share about and teach about with others. It's the importance of, hey, look to build other sources of income. It doesn't matter what walk of life you're from or what career you're in, but Diversify. It's so important.
Yeah. No, I completely agree. I think it's you got to have something. I mean, that job that you have is oftentimes feels like the safest option, but I think in reality, if you don't have control over it, then any number of things can happen. Like you mentioned, the dot-com bubble bursting, but I mean, it could be as simple as so they want to downsize a company,
Yeah.
maybe you have an illness and can't perform that job anymore. Like there's just things that can happen that if you don't develop ways to have passive income, it could be a problem ultimately down the road. Nothing wrong with having a job, nothing wrong with active income. That's just you need to use that active income to get into have it invested so that you can then also create passive income sources.
Yeah.
So why notes for you, Fred? What's your why is that your focus? What's appealing to them for you?
Well, a lot of things, a lot of reasons. I love real estate in general as an asset class. It's great, but I'll tell you what, Jason. Owning rentals and owning and managing rental properties, it's a great way to build wealth, but it's not for everyone.
Mm-hmm.
It takes a lot of work. It's a lot of time and effort. And if you're good with that, you can do really well with it. But for a lot of people, I find that, hey, they say, hey, I'm busy. I have a busy lifestyle. I can't spend time managing rentals. And so what I found is that investing in notes, which is buying the notes and mortgages associated with those rental properties and owning the debt, it allows you to step into the shoes of the bank and become the lender. And then you learn why banks are not in the business to own rental properties or any real estate. They're in the business of being a lien on title and collecting cash flow from lending, from being the lender. And it's not a bad thing, right, for the banks, because there they are. Their investment is secured by collateral. It's protected, and they're not owning the property. So the owner of the property is responsible for managing it, maintaining it, replacing the heater when it goes, replacing the roof when it needs to be replaced, all of those things. And yet they're making income all along the way. And so what I found is scaling up a portfolio of rentals where you own them. It's a lot of work, and eventually it gets to a point where you can't continue to grow. You're kind of maxed out on what you can handle. But if you were buying a portfolio of notes, you could continue to grow and expand that almost with no limit. The only limit is the capital that you have. It's a very repeatable business. So that was very appealing for me, the scalability of it. And over time, I started focusing less and less on real estate and moving more and more towards investing in notes. And it's been a wonderful journey for me.
Yeah. Yeah. I think, all of those are very, I think, important points for people to understand, and definitely not it's almost, well, you can probably speak to this better, but it seems to be one of the most passive ways that you can invest in real estate if you're looking at it from a note perspective. Now, the funny thing about me saying that is that I have no idea how to, outside of investing with someone who's already getting them like your fund, I have no idea how you would access the notes that you might want to invest in. Like how do you go about finding them and identifying which are good notes to have? I assume there's some.
There's all kinds.
Yeah, I was like, there's going to be different levels of quality to those notes.
Absolutely. There's all kinds of notes, and there is that classic risk reward ratio with what's your risk tolerance, and the more risk you're comfortable with, then you can earn higher rates of return. But you also have a greater chance of problems or losing your investment if you don't do things properly. So yeah, how does someone just hearing about notes, maybe you're hearing about this concept for the first time, how do you get started? Right? There's a couple different ways. So I always say this: the first thing you have to do is think about how much time do you have, and that goes into the decision of, do you want to be a passive investor in notes or an active investor in notes? An active investor is going to go out into the secondary mortgage market and buy notes and build up a portfolio. And then you build the portfolio, you manage it, and you grow over time. And there you are collecting the payments. But your job is to be out in the marketplace finding notes to buy, which takes a lot of work. It makes what seems like a passive investment activity, it makes it very active. It takes a lot of work. Notes are bought and sold on the secondary market every day, and it's all done through relationships. This is a relationship-based business, and so you have to work at building those relationships. We buy notes from other note funds, from hedge funds, from other investors as well. There's a lot of different places. Banks, lending institutions sell notes all the time. Even Fannie Mae, Freddie Mac, you can go on their website and look at the prior quarter of sales of loans. It's public record because of the nature of their governmental entities and association. So they're published there for the public to see. Those are huge, huge transactions, which you or I probably are not going to be buying pools of loans with thousands and thousands of loans in them at one time. These are gigantic transactions. But there's institutional investors on Wall Street. They buy these. The pools end up getting split up, broken up, and it cascades down to smaller investors of every size. So that's how we find notes to buy. Now, for a lot of investors, they may say, hey, this looks like a great business, but I want to be passive. How do I do that? Well, the way to do it is to invest in a note fund. And a note fund is where the fund managers raise capital from investors, and then they'll go out into the secondary market with that capital that gets pooled together, and they're buying notes in bulk quantity. And what's nice about that is they're able to negotiate better discounts and get better access to notes and build and manage a portfolio. But the benefit for passive investors in this arrangement is that they get to leverage the expertise, the experience, and the relationships of the fund managers, right, which is access to notes. And now they're able to earn a passive return in exchange for that. And so a lot of investors, they may have cash from a property they sold, or maybe an investor has an old 401k from a prior employer. And so it's a great way to put that money to work with it being a hands-off investment. And so those are some of the ways to get involved in note investing, whether you're looking to do passive or active investing.
Yeah, it's a fascinating space in large part because I understand physical real estate. The note side of it is definitely where such a scenario where I'd be coming to someone like yourself. But so the last couple of years, since 2022, rates went up. Things have been challenging in the physical real estate space. What have you seen in the mortgage note space, or have you seen anything? Has it impacted your business better or worse? I mean, what are you seeing over these last couple of years?
Yeah, over the last few years, we've seen a number of things. So certainly in the beginning I would say the first 18 months of the pandemic, we saw a very significant tightening of liquidity. And when that happens in the mortgage market, a lot of loans get put out for sale. And so we saw a lot of opportunity to buy and acquire notes, which was great. Um, and other than that, we've seen interest rates rise significantly the past few years. So what has that done? That has brought loan payoffs, which used to happen a lot because people were refinancing into lower rates, right? This has diminished significantly. So that's been one change. People are staying in their homes longer than ever right now, right? We always hear the statistic that the average lifespan of a residential mortgage note in the U.S., it's 5 to 7 years. Even though it might be on a 30-year loan, every 5 to 7 years, people are either moving or upgrading or getting to a better school district or moving for work reasons, or maybe they're refinancing to take advantage of stronger interest rates or pull out cash from their equity. And so that's been another change as well. We're seeing a lot less loan payoffs happening than usual. But other than that, real estate gets bought and sold every single day. Most of those transactions are done with financing. So mortgage notes are being originated, and the majority of lenders, when they create a mortgage note, they turn around and sell it very soon after closing, usually within 3 to 6 months. And I'm sure most of you listeners out there have experienced that, right? You buy a property or you refinance. It doesn't take long to get that letter from the bank. Dear Mr. and Mrs. Homeowner, we're writing to let you know, to advise you that your loan has been sold. Here's the address, contact information for the new lender, and please start making your payments to the new lender starting next month, right? We've all experienced that. So that is the secondary market at work.
Is that the more common way? It seems like, unless you get your mortgage from like a Bank of America or something like that, it seems like most of the mortgage brokers, in my experience, it's almost always that it gets sold, sort of shortly after you close that loan. Is that the norm for most mortgages in that industry? Yeah.
It is the norm. And here's why. Banks and lenders, they're in the business of originating loans. And so when they create mortgages, they're not going to hold them on their books long term. They want to sell those loans so they can recapitalize. And why is that? It's so that the very next day, after the loan gets sold, they have capital and they can turn around and originate a new loan for someone else. It's a very high volume, high velocity business. And the more times per quarter that they can turn that money over, they're making money on their points and their application fees and all of that. That's the nature of the business. And then on Wall Street, you have all these securities, Wall Street securities, hedge funds. They're buying all those loans to create products. So there's a big market for that. And a lot of those mortgage securities, they only exist for a fixed rate of time. So it might be for a few years. And then at the end of that, the bond gets collapsed, and all those loans have to be sold off and resold. And so it's very common to see loans change hands of ownership multiple times when we're looking at them to buy them.
Yeah, it's a fascinating industry, and I think the maybe point for people to understand there too is that a lot of those mortgage companies, the brokers they don't care about the interest. That the passive income comes from that interest that they care about, like you said, turning that money over and
Yeah,
getting to charge the fee again. And that's, I mean, that's like same thing with, say, hard money lenders in for home flippers. Like it's less about the interest than it is about sort of turning that money and getting
that's
the
right.
fees at the front end over and over again. So
That's exactly right.
yeah,
It's called the velocity of money.
I was just going to say that. Yeah, the velocity of money is a very powerful thing. Um, so you mentioned that over the last couple of years, those loan payoffs are down a lot.
Early payoffs,
You,
I mean.
yeah. Have you
Yeah.
had a lot of? Has there been a lot of distress in the note market? People talked a lot about distress in especially in the the multifamily space. Office
hmm
maybe experienced a lot of, people talked about it in the physical real estate space. Have you seen a lot of distress in the note market?
Well, I focus primarily on the residential space.
Okay.
Um, and so, no, we have not seen much distress at all. And think about this right now in the way the real estate market has been, there's a very high demand in most markets across the US. And so we don't see too much distress at all. And I'll tell you what, if a homeowner were to get in financial trouble and get behind on their mortgage, it's very easy, and they have equity in their property, most likely. So it's very easy for them to get the property sold quickly and pay off the loan and get out from under it. And so, to answer your question, no, we haven't been seeing much distress at all. It's very infrequent, I would say, in these
Yeah.
times.
Well, and you mentioned, I guess the the other piece of this is that so many people did refinance or purchase when interest rates were extremely low, and so maintaining an interest rate of 2.5-3% is a pretty motivating
Yeah.
pretty
Oh, yeah.
motivating factor to pay that mortgage when if you were to buy something else, you're very likely going to pay similar purchase prices, but your interest rate will be twice, if not three times as much as it was. So I think it's uh,
Absolutely.
well worth it to stay in the home that you have and make sure you make those payments
It is.
rather than sort of defaulting and having to start all over again at a higher rate. So it makes a ton of sense.
Yeah, and in addition to that, that same phenomenon is keeping people in their homes longer than otherwise. Like people really think twice about moving because of that reason. They don't want to give up a very low interest rate. And so maybe people are staying in their homes much longer than otherwise they would.
Yeah. Yeah, absolutely. I mean, it's fascinating how that all ties together and sort of trickles across industries, or sort of all still within real estate, but the construction industry is doing quite well because people want to remodel their homes instead of buying a new home, and there's just a lot to it that I think is once you start to understand how it's all so intertwined, it becomes pretty fascinating to see
It does.
what the process will be, and probably understanding that helps with I don't know if prediction's the right word, but sort of your outlook for the next few years. It would seem to me that we're probably going to be in this cycle on the note side of things for quite some time, for the same reason, is that unless interest rates drop dramatically, people are going to be pretty happy to stick with that 3% rate. Do you have any sort of thoughts on outlook from your perspective in the notes market?
Yeah, as far as interest rates, we saw interest rates rise up very fast, very, very fast. It was um, unprecedented, that rate of increase. And so they went up and they came up to what I consider historical average
Yeah.
amount, like 7, 8%. If
Yeah.
you look back, um, if you look back long term, that's about average. And so, what's going to happen now? Well, there's a lot of moving parts, a lot of variables, and things happening in the economy. But I would say, if any, and we're seeing this, any change now with the interest rates, it's very slow, small changes, small adjustments being made, right? I heard the an analyst from Bankrate make this analogy, and I thought it was so true. They said that interest rates rose up on an elevator, and they're going to take the stairs going down. That's such a true analogy. And we've been seeing that interest rate adjustments. Yeah, they're being made very carefully by the Federal Reserve, and they're small adjustments. Make a small change and then wait, see what happens, and then reevaluate the next quarter. And I have a feeling that's what we're looking at moving forward.
Yeah. It makes a ton of sense. I think it's, it's been an interesting time. Like you said, unprecedented elevation of rate. It really in the speed that they elevated, because as you said, historically, 7-8% is probably about normal. I think the first mortgage I ever had was 10%.
Yeah.
And so things came down over time, and so 7-8% is pretty normal. The abnormal piece was the 3%. We may get back there, who knows? But I think thinking about it from a what is normal over decades, we're probably right there right now.
Yeah, imagine there's this whole generation of people that are 20 and 30 years old that's all they knew. Like they got out into the working world, and all they knew was 3 and 4% interest rates.
Yeah. Yeah. I mean, it's just, and it was that way for a while. I mean, we really did kind of stay in that 3 to 5% range for quite some time. But yeah, before that, it was, I mean, I don't know. I feel like my mom told me her first house was 17% interest.
Or double digits where it was common.
That was normal then, and people are happy to be able to get a house, get a loan. So I think it's perspective. It's kind of like you said, there's a generation of people that all they've known is ultra low rates on their mortgage, which is a really nice way to be able to borrow money. So the flip side to that is you don't make a lot of money on your saved income, right? Anything you save in the bank, it's hard to get a high return on, savings rates and things like that. So it's all tied together. It's just, kind of, that's how it all works. And figuring some of that out can help you make decisions towards what's the best way to move forward for yourself, whether that's, in investment vehicles or, purchasing a home or staying in the home that you have. So all things that are really great to know. Fred, let me switch gears here. I won't ask you all the questions because you were on before, but I do like to ask, what is your why? The name of the show is Know Your Why. And I think that does, sometimes I've joked about changing the name of the show to The Evolution of Why, because I think it sometimes changes for people over time. But what is your why? What's driving you and keeping you motivated at this point?
Yeah, I love this question, Jason. Thank you. So my why is to make a positive impact, to impact people in a very positive way. And so this is what I'm doing through my body of work, through the ideas and the concepts that I share, is to make a positive impact on your financial future, the financial resiliency for yourself and for your family. I feel that this is an area that sometimes may get neglected as we get busy with life. And so I'm here to bring up a reminder and shed some light on, maintain some focus on this, where as you go about living your life, spend some focus and effort on your financial resiliency, which is going to protect you and your family and give you more options and choices in life ultimately. And so that's my why.
Yeah, no, absolutely. And I think it's tremendously important. People need to know that the they need to know the options that are available to them. And I think sometimes, it takes people like yourself getting out there and spreading that message as far as what do you have to better your life? What's available to you to better your life? Because it's not always taught in school. It's not always, stuff that our parents knew or anything like that. So, kind of understanding a lot of this, I think, is just investing a little bit of time and energy into learning and, having conversations, listening to conversations with people like yourself can make a really big difference. So, with that being said, I truly appreciate having you back on. What's the best way for people to reach out and connect?
Thank you, Jason. Yeah, for anyone that wants to reach out, connect with me, visit my website, which is fredmoskowitz.com. If you prefer a little bit of an easier spelling, you can visit giftfromfred.com. It will take you right to my website. And when you're there, you can learn about my book, about note investing. You can request a special report that I have on note investing. I'd be happy to send that out to anyone that would like. And you can send a message, connect with me. I always love connecting with people that are interested in investing or investors themselves and building relationships, because it's one of the most important things that we do at all times. It doesn't matter what business or industry you're in. Building relationships is a very important skill and activity. And I look forward to connecting with you.
Yeah, well, absolutely. And we'll put that in the show notes so people can find you. They'll have the right spelling of your name, but gift from Fred is definitely an easier thing to remember. So
it is. It's easier to put that in the web browser,
Yeah, exactly. We'll have all that in the show notes. I do want to say thank you again. Thank you for the time. I think this is a fascinating topic, and I think not frequently talked about. I just think you can go out there and find a lot on social media about a lot of different investment vehicles, but I think note investing is maybe flies under the radar a little bit, which I don't know if you like that or not, but I think it's great that you're spreading the message and giving people more opportunities to diversify their portfolio. So thank you.
Thank you.
And folks listening, please connect with Fred, and please like, rate, and review the show so we can get more great guests. And as always, thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?